Welcome to our case study video, where we're going to take a look at the kinds of returns you can expect to see within your retirement account when investing in a multifamily property. At Walta, Maine, we've built a UDFI calculator. So for any given deal, we can generate the taxes that would be expected on returns if investing with a self-directed IRA. With a solo 401k or EQRP, there are no taxes, so that'll be even simpler. Let's dive in. So in this case study, we're going to assume that we make a $100,000 investment in a property that we closed on last year. These numbers are based off the returns we projected when we put the deal together. So right off the bat, we see that in year 3, $61,000 of your original investment is returned to you through a refinance, and in year 5, just under $39,000 is returned. Again, this is your original capital, so there are no taxes involved. You can go off and reinvest this money into another deal. Now let's take a look at cash flow. Here are the returns for years 1 through 5. If you invest in the deal with a solo 401k or EQRP, these are the returns you should expect to keep. No taxes are involved, and all of that hits the bottom line of your account. If you're using a self-directed IRA, we've found that in most deals, the losses generated by a multifamily property will shield you from taxes in the first 3 to 4 years. In year 5 upon sale or another refinance, this is when you would expect to pay capital gains taxes. As you can see, the tax itself is a sizable amount, which reduces our returns from $114,000 to $84,000. While it's a large chunk, what does that mean on an annualized basis? While taxes have reduced your returns annually by 6%, we are still realizing a return of 16.9%, which over the span of 5 years is still a fantastic outcome. And looking at IRR below, which will take into account the time value of money, we can see that returns are even better, only being reduced by 4%. So again, this is based off a single deal. You're likely going to be holding onto your IRA or 401k for longer than 5 years, so why not look at an extended horizon? If you recall, we had $61,000 returned to us in year 3 and $38,000 returned to us in year 5. Let's say that when your capital was returned to you in year 3, we invest that amount as well as the cash flow we've seen from years 1 through 3 back into an identical deal such as this. And then we'll do the same after year 5 with the returned initial capital and cash flow from years 4 and 5. In total, this will mean we've invested in 3 properties across an 11-year time span. So what do our returns look like? Illustrated in dark blue, we have the growth we'll see in a self-directed IRA over an 11-year time span, while illustrated in light blue, the returns for a solo 401k or EQRP. Right off the bat, we can see visually that taxes did make an impact. But were we still able to generate solid returns through our self-directed IRA? In fact, we have. We turned our original $100,000 into more than $389,000. And over an 11-year time span, this works out to a 26.3% annual return. Even though we had to pay taxes on our capital gains, we still generated incredible growth for our eventual retirement. But if you have self-employed income and are able to invest through a solo 401k or EQRP, we've turned our original $100,000 into over $526,000, meaning a 38% return annually for 11 straight years. The difference between investing through a self-directed IRA and a solo 401k was nearly $128,000. Now, obviously, as we all know, life doesn't exist in a vacuum. These returns could trail or exceed expectations, but this case study is meant to illustrate the power that multifamily can bring to your retirement, whether it's through a self-directed IRA or one of the tax-free options instead. And while self-directed IRA returns are phenomenal when investing in multifamily, solo 401k returns are on a different planet. And as this case study has shown us, a tax-free environment can provide you with the retirement you've always expected. Now let's talk about a custom case study for you. Look at all those divided by 0 cells waiting to respond to data inputs based on your investment. And as I've mentioned, we've built the real estate industry's first UDFI calculator. When we have a new deal, we can generate the expected returns, including expected taxes. If you choose to invest with us, we'll always provide you with an idea of what taxes will look like based off expected returns. And if you like, let me know the exact amount you plan to invest, and I can update the calculator to provide you with even more accurate expectations. So hopefully this sparked an idea in your mind and possibly inspired you to take action in providing yourself with the future you've always known you were destined for.